Hey guys, welcome to Mind Leaves. My name is Minika. Today we're going to talk about some mistakes beginner investors might make and how you can avoid it. Let's start right away. Okay, so I don't know where you are investing currently, but I'm very happy investing with eToro. On eToro, if you do not leverage, you pay zero fees on stocks and ETFs. So if you're interested to sign up with eToro, you can use the sign up link down below in the description. Okay, so there are a lot of things going on in the world currently, and we're living in a fantastic time in terms of technology and the internet. So let's just start off the video by appreciating the time we live in terms of the tremendous amount of information we have available right at our fingertips. Times have changed a lot, and the world is evolving every day more and more rapidly. Sometimes this idea is a bit scary as well. But because of the internet, things like these are not even owned by the majority of people anymore. And there are way more efficient ways of going about your day and your journeys. You can book a place to stay for a night literally anywhere in the world in a matter of minutes right here on your phone. You can book a plane ticket, well, you used to, in the comfort of your living room or in a coffee shop without the need to go and visit a travel agency to do it for you, to pay them to do it for you. You can instantly get reviews or opinions from a variety of people with different perspectives. I mean, it's kind of insane what we have gotten used to as normal. But I know you are wondering, what in the universe does this have to do with beginner investing mistakes? Well, let me get us to the point. Now, I can't help to think the same about investing and planning for your own financial future. It's just not the same as it has been many years before. Investing over phone calls with brokers, or depending on the guy at the bank who supposedly was the only one with all the information, getting quarterly reports with the stock charts on it in the mail, which was probably the best option for that time. Some might even say it was better to only receive quarterly charts. Some might even say it was better to only receive quarterly charts. Then maybe people wouldn't have panic sold so easily during corrections. But for the average Joe investor, it came down to having someone at the bank who does your future planning for you and doing your investments for you, or having a physical financial broker that you pay to act on your behalf. Of course, using a broker meant paying a lot of extra fees. So in 1992, just as the internet was starting to emerge as a viable option for the average Joe investors, a full-service broker could charge a 2.5% commission for a stock trade. That meant that the purchase or sale of 100 shares of corporate stocks could cost you a couple of $100. I like the way that Michael Kitces puts it. The reality is that before the internet, the average investor didn't have the tools to know that so many actively managed mutual funds underperformed their benchmarks, and how to select which were the few funds that were actually good. Instead, most investors could only look at quarterly statements or the Wall Street Journal's pages of stock prices and figure out that they had made money because the investment was up, but not actually whether it was up more or less than it should have been given pure comparison. Okay, so pre-internet, there was a whole lot of room for dishonesty, mistakes, and undetected bad choices. With the internet came a whole wide web of information, a higher level of transparency, and a greater sense of control at the consumer's end. When the internet emerged, investors like you and me could actually do real performance benchmarking. In other words, identifying how well a mutual fund was actually performing, comparing costs, and clearly seeing what was actually in the tank. For me personally, the greatest countermeasure to high fees in the post-internet world is the fact that there are way more passive funds and less actively managed funds. Thus, it can be way cheaper to invest in certain markets. Alright, so now I know you might think, with all these advantages that we have at our fingertips, what could go wrong? Thank you for still bearing with me until this point. So with no further ado, here are some mistakes I think beginner investors make, even though there is a lot of more information available to us at the present time. I think there are like 8 or 9 mistakes. Okay. First one, thinking you are not able to invest because you know nothing about the stock market or investing. So I can definitely resonate with this. Not too long ago, I was really just way more comfortable trusting anyone but myself to do the investing for me because of the level of knowledge I had about stocks and the market or short and long-term investing, etc. Someone just had to tell me who I should give my money to so that I can just sit back and relax. But like I have mentioned many times in some of my previous videos, no one cares as much about your money and your financial future as you do. Doesn't matter who you are. It might seem overwhelming at first, but just learning some fundamental basics opens a whole new world where you might feel much more empowered when it comes to investing. If you want, you can check out my video up here, which one? If you want, you can check out my video up here on investing for beginners. It might give you some basic tips just to get you started. The second mistake, you're too scared you'll invest into the wrong thing, lose a lot of money, or get caught off guard by a ton of hidden fees. Okay. The fact of the matter is that if you are like me, who didn't have a clue about anything investing wise, one thing that you have to remember is that the great thing about making mistakes is that they teach you a lot more than making no mistakes at all. So a quick tip. Start investing into well-established markets to get comfortable with the whole investment world. I also have a video that I will link up here on some of my favorite Vanguard ETFs that are great just for this purpose. Alright, the third mistake, delaying to start or analysis paralysis. The worst thing you can do is not to do something because you thought too much about doing it, that you got too scared and didn't do it. As I get older, it feels like time flies by way quicker, and this makes me regret more things that I didn't do. And I realized this was mostly because of overthinking and overanalyzing situations. Okay, but don't get me wrong, doing due diligence on investments are vital, and I would never ever disregard that. And sometimes it's definitely crucial to walk away from certain investments, but don't let overanalyzing paralyze you to never invest at all. Number 4, waiting for the perfect timing. Yeah, you're never going to do it. I hear so many people saying, I will start to invest when the market is in a dip. And I have to be honest here, this way of thinking is something I really have to fight as well. So I don't wait for the dip anymore. I dollar cost average into my investments. Now this means you consistently buy into the market like once a month, not necessarily focusing on the price fluctuation in the market itself. Not only is this the most successful investment strategy known to all YouTubers, but it also grants you so much more freedom in your mind because you're not concerned with the market prices consistently. Another thing is you might wait for the dip to invest, and once it hits, you don't invest. Why? Well, this is because of market sentiment. Let's take Bitcoin as an example. The crypto market is down, and investing into Bitcoin at this price is so much better than buying it at 60K, where it was just a short time ago. But even though everyone knows this, the market sentiment just does not feel the same. Buying Bitcoin right now is scary, and you will feel alone in the process because none of your friends are doing it, and maybe it's just going to go down further and further. Buying it at 60K feels so much better because of the excitement in the market, and everyone and their dog is talking about it. But the reality is reversed from the sentiment. Like wise old Mr. Buffett has said, be fearful when others are greedy and greedy when others are fearful. And lastly on this point, in the long-term bullish market, the buy low and sell high strategy makes little sense because few purchases are made and the long rallies are missed. In the S&P 500, there are periods lasting a couple of years in which there is not a single price decline of 5%. Imagine you're waiting 5 years to buy that dip. So for investment periods of 10 years, the simple strategy of dollar cost averaging, buying regularly into the market, outperforms anyone who tries to time the market. Number 5, obsessing over fees. Guys, we're on a roll. Thanks for still being here. If you are still watching at this point, let me know down below by typing anything with the word obsessing down in the comments. Alright, so obsessing over fees. Okay. Sorry, battery. Yes, fees are definitely something worth looking out for. So make sure you aren't being ripped off where you are currently investing. But as I have mentioned many times before, in our day and age, investing has really become so much cheaper than a decade ago. And taking into consideration the growth that a standard S&P 500 index tracking ETF like Vanguard's VOO will give you an average of close to 15% annually. Now the fee it will cost you over 30 years to invest into this ETF is not even worth breaking a sweat about. So don't cry too much about the fees and just do it. You're losing a lot of time and money by just standing on the sidelines. Alright, number 6. Investing while you still have high interest consumer debts. When you have high interest debt, the best way for you to invest is to pay off your debt. This is quite easy to explain, but sometimes hard to grasp. Let's say you made an investment last year and it gave you a return of 10%, which is quite decent. But you had a credit card, student loan or car payment that was in excess of 12% interest combined. You have effectively lost 2% on your total investment. Obviously, being more specific with the amounts and the precise interest rates will give you a more accurate picture. But generally, trying to invest while still having high interest debt payments is making you move backwards financially. Really. Mistake number 7 beginner investors might make is immediately buying single stocks. Single stocks are usually seen as high risk investing, especially if you are new to investing, only buying into Tesla or only buying into Apple. Just because it's basically the same concept as putting all your eggs into one basket. I think if you really develop an interest in the stock market or certain stocks in certain companies and enjoy doing a lot of research about the specific stock, then it's a different story. But by just acting and buying on the basis of FOMO or your friend telling you it's the next big thing is not a good idea. Rather, start out safe by buying something more diversified like a mutual fund or an ETF. Number 8, putting all your cash into the stock market. Even though I would always recommend investing the majority of your money because of inflation, I mean, just leaving your money in a bank with an average of 2% return will influence the value of your money tremendously in the long run, aka your money will lose a lot of value. But with that said, cash is still a very important thing to have. Easy, accessible, liquid cash, or what we usually call it an emergency fund. At least 3 to 6 months of life expenses saved up that you just leave right there to give you that peace of mind and a good night's rest, and that you can deal with an emergency when it comes. Because no one can ever truly time the market, and you might just buy right before a huge crash and lose a lot of your money in the short term. Emphasis on short term. And as Peter Lynch always says, if you need the money in the next 2 years, do not put it in the stock market. But if you do invest for the long run, the stock market is a great bet. Thus, save up your emergency fund and then enjoy the awesome journey of investing. Number 9, listening too much to other people. It is very important to create your own opinion because there are a lot of opinions out there of the best way to go. And everyone is very confident in their own way, even though most of them differ from each other. You get your crypto guys, your commodity guys, real estate guys, the only mutual funds and nothing else guys, the single stock guys. But they are all so confident in their ways for a reason. Their confidence is probably backed by a mountain of research and time invested to affirm their beliefs. So make sure to find your own confidence by doing your own research and not just sheeping behind other people's strategies. Research, experiment, and figure out what is comfortable for you and what are you confident to do. Alright, and those are just a few mistakes I can think of and resonate with. Let me know if you are guilty of some of these mistakes or any mistakes that I might have missed in the comments down below. Once again, thank you guys for watching. I hope you found some value out of this video. If you did, a like is always appreciated. I hope you guys have a fantastic day, a healthy, wealthy life, and happy investing. I will see you in the next one. Bye. Some might even say it was better to only receive quarterly charge. People wouldn't have. Some might even say it was better to only receive quarterly charge. Blah. Some people might even say it was better to Some people might even say it was better to only receive quarterly charge. Charts.